Hey guys, how's it going? I'm Lewis Harding Investor and welcome back to my channel. And in today's video, I'm going to be going through Adobe stock. I'm going to be using fundamental analysis to see if the company is worth buying or not. I'll be then using a DCF valuation to determine the fair value of their stock. Let's get straight into it. So who are Adobe? So Adobe Inc. is an American multinational computer software company. It's incorporated in Delaware but is headquartered in California. So it is historically specialised in software for the creation and publication of a wide range of content, including graphics, photography, illustration, animation. And to be fair, most people will know them for PDFs. They invented the PDF and Adobe Photoshop. The Acrobat Reader, so that is basically PDF. All sorts of different like creative suites and all that. They're a software company, so people pay monthly for all of this, all of this software basically. So the company was founded in 1982 by two guys, and yeah, they established the company after leaving Xerox. Yes, the printer company Xerox, and yeah, the company itself has 21,000 employees worldwide. The company itself is in the S&P 500 and it is listed on the NASDAQ. Now let's have a look at the numbers and we'll start with the sales. So for 2020, 72% was made up of digital media, 24% of digital experience and 4% of publishing and advertising. Sales per region, so about half the sales come from the United States and half the sales come from worldwide. So most from the US, but the rest worldwide. Not too US focused though, which is a good sign. Now let's have a look at the income statement, and all of this data is in US dollars and it is all from macrotrends.net. So the first figure, revenue. This company has exploded over the past 5 years, over doubling its revenue since 2016. So cracking stuff there. What can you say? Double its revenue. What pandemic for Adobe? It's actually been a good thing with everyone working at home and having to use digitalization of the world economy. Adobe is at the front of that. So they haven't just increased their revenue by a lot, but the profit as well has just gone up loads. The revenue has doubled in 5 years, but the profit has quadrupled. Amazing stuff. And yeah, you can see as well the shares outstanding are actually going down, which is a good sign for us investors. Now let's have a look at the balance sheet, and the two main figures to look at from this balance sheet extract is the long-term debt figure and the retained earnings. So let's start with long-term debt. So it's a bit all over the place, isn't it? So 2020 it was 4 billion. 2019 it was just under $1 billion, and then 2018 it was 4 billion again. So I'm not sure what's going on there, but over the past 5 years it has increased. You want this to be going down over time, of course. So it does make you think, why have Adobe taken on debt? Maybe because of the favourable interest rate conditions. They could probably borrow at around 0%, and it's basically free money. So why wouldn't you if you can? Return earnings, yes, this is up over time because they're making a lot of profit, hence return earnings being up. Let's move on to the next bit. Now onto the cash flow statement, and as to be expected, the cash flow from operating activities is up massively, hence free cash flow is up a lot. What I do like about this business is that they don't have much in capex, so net change in property, plant and equipment, it's not a big figure and it doesn't eat into their operating cash flow, hence high free cash flow. You do see this with software businesses, but yeah, it's just good to see on paper. Numbers are factual and they're going up over time. Winner, winner, chicken dinner. This company doesn't pay a dividend. Not many tech companies do pay a dividend because they can reinvest into their business and make a higher rate of return internally, hence the stock price will probably go higher. Right, so let's have a look at the key financial ratios for Adobe, and yeah, it's pretty impressive, let's just say that. The current ratio and long-term debt to capital, all very, very good. A lot of liquidity, great long-term debt to capital. High profit margins, 41%, unbelievable stuff, and in the high 20s usually, so what can you say apart from awesome. Return on equity is also very high. This is just an awesome business, isn't it? Let's be honest. Now onto the genuine impact stats, and we will start with the quality metrics. So yeah, very, very high quality wise. You can see from that shield around the three main sections, it is one of the most high quality businesses on a genuine impact platform. You can see profitability, financial strength and capital allocation, very high, strong and sound, so really good stuff. On the value metric, it's looking very expensive unfortunately. Not really surprised it is a tech darling, very expensive across the board. But thankfully there's a lot of high growth in this business, as you can see in the bottom left hand corner. High quality, just overpriced. I think this is going to be a recurring thing with Adobe. Now moving on to my analysis checklist for Adobe, and let's get straight into it. So 312 billion market cap, and yeah, the company is listed on the Nasdaq in the US. We will start with my first pillar, so profitable, high returns on capital using low leverage, smashes it out the park. Really profitable business, 86% gross margin, 5-year average, unbelievable. 28% net profit margin, 5-year average. What can you say? Just really good stuff. Return on equity is also extremely high, and yeah, there's not much debt and there's a lot of liquidity in the business. Just awesome. Proven ability to grow. So yeah, as we've seen in the previous few bits, it's a high growth business. Even at its size, it's growing quite a lot still. Smashes it there. Great capital allocation, decreasing shares, good acquisitions. Unfortunately, a little bit of debt has been issued, but not really a big issue, let's be totally honest. No dividends. This is something I would like to see from Adobe, even a small dividend started. If they can't use their cash wisely, get paying some dividends out to shareholders, reward them for holding the stock. High quality score of 85%, one of the highest around. But unfortunately for this business, like with many other businesses out there at the minute, it is overvalued in my opinion. So yeah, for a 10% return, it needs to drop 66%, and the PE ratio is currently 54, and the price to free cash flow is 47. So overall, high quality business, but overvalued. Now let's have a look at my DCF valuation for Adobe, and all of my free cash flow figures have come from marketscreener.com, using analyst estimates going into the future. Yeah, so for a 10% return, we're looking at a share price of $225 per share. You may balk at this, but before the pandemic, Adobe was a $200 stock, $180 stock. So it's not beyond the realms of possibility that it could end up down back there at some point. People would argue that it's a high quality business, so it deserves a high valuation. Agreed, maybe, but to achieve my investment goals, I need returns of 10% plus. So yeah, great quality business, but it's just looking overvalued, simple as that. So what are my thoughts on Adobe? So you probably know what I'm going to say. Absolutely high quality business, one of the best around, very profitable, high returns on capital, low leverage. It is growing, it is just a fantastic business, but unfortunately, like many companies at the minute, overvalued, simple as that. This company needs to drop 66% for me to achieve a 10% return. So for me, it's simple. High quality business, add it to the watch list. This will be a part of my portfolio in the future, whether it's 1 month, 1 year, who knows how long it'll be until it drops, but it will be a part of my portfolio at some point, because I want to own high quality businesses at fair prices, and if I can get this for a 10% return, I'll be very happy. So yeah, what can I say? It's just overvalued like many stocks at the minute. A 66% drop is quite dramatic, but like I mentioned before, this stock pre-pandemic was a $200, $180 stock, so weirder things have happened. So yeah, simple as that. Great company, but overvalued. So if you enjoyed today's video, then please subscribe to the channel. Thank you very much for watching. I will see you next time. Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos